Hey everybody, welcome to everyone today. My name is Beth Brooks. I'm the director of the ASBTDC at the University of Arkansas. Thanks so much for joining us. We're going to learn all about starting a business in Arkansas. Our programming today is sponsored by our friends at Bank of America, and you're going to be hearing from Meagan a little bit. Thanks so much to them for their support of our clients and all of our services that we provide. Just in case anybody doesn't know about us, the ASBTDC provides complimentary consulting services to small businesses in Northwest Arkansas. We provide support to all stages of entrepreneurship, from startups to existing small businesses looking to expand, to long-term businesses needing help with cash flow. And then we help a lot with entrepreneurs who are buying and selling their businesses. We work to meet pretty much the changing needs of all of our small business community. Our clients look to us for strategy and business planning and market research, really intricate financial projections, marketing guidance, and sometimes they just need somebody to listen to them. So we're always here to help. You can check out our website at sbtdc.uark.edu. Call us on our phone at 575, that's area code 479-575-5148, or you can always email our office at sbdc@uark.edu. We have a really great lineup of speakers for you today. We have Henderson from Wright, Lindsey, Jennings. He's going to discuss legal and tax issues. We have Meagan, Locke here with you from Bank of America. She's going to present some great information on small business financing. And then Lieblong is one of my colleagues here at ASBTDC at the University of Arkansas. She's going to review business planning and idea feasibility. So each speaker, the plan is each speaker is going to do their own presentation, and we'll open it up after each one of their presentations for a little bit of Q&A. Feel free to type your questions into the chat, and we'll kind of accumulate those so that we can then present them all together. Last note is that this webinar is being recorded, so the clients are able to continue to learn from the content. So Lori, why don't you move on and get your presentation started? Move that slide for us. Thanks.
Okay, so this is kind of the agenda for what we'll go through today. First, I will talk to you about whether or not your business idea is feasible, the things you need to consider to understand that. Then we will talk through our format for a business plan, which you will find is actually not very complicated. We'll talk about some other considerations that you need to think about when starting a business. Cole will talk about legal and tax issues, and then Meagan, who's joining us from Bank of America, will talk about financing, and then we'll do a quick wrap up. So first things first, you need to think really hard about whether or not this business idea, before you jump in, spend the money, do all the work, is whether or not this is really going to work. And the key things you need to look at when you're making that decision is the market, whether or not you really want to manage this and do this, and then whether or not you have the funds to do it. So the first thing you want to think about is there a market for this? Is this really something that people want to buy? I worked in the vitamin industry for 10 years before doing this, and in corporate America. And so I like to use this because we had a really good strategic product line that we launched, and it's got some really good examples. So I use that throughout this presentation. So one of the things you want to look at first is a global industry, and whether or not that is driving demand for your product and service. So we know in the last 10 to 15 years, the health and wellness industry has expanded. People have more information about how to take care of themselves in general. People are learning more about body systems, what they can do to live longer, how they can take care of themselves. People are starting to want to do things to prevent health issues later in life. And this isn't across every single person in the United States, but it's just some general information that people are getting and a better understanding. Well, this is driving demand in certain product categories. If you live in Fayetteville, one of the things I always say in Fayetteville is it's amazing to me, in a population of a little over 90,000 people, which includes college students, we are able to maintain Ozark Natural Foods, Whole Foods, and natural grocers in Fayetteville, which is pretty amazing to me. If you look at Walmarts in certain areas, the set for, that's what it's called in retail strategy, for activewear is growing. And that's not in every area. I'm not going to get into retail strategy, but those are just some concepts to show you demand is really growing in that industry. So for us in the vitamin business, demand was growing for our product lines. So we had some ideas that were growing in the food industry. So gluten-free, organic, all natural, preservative-free. Those were trends in the food industry. And you're probably seeing this already in Walmarts. You know, we think of Walmart as just selling the bare basics, and Ozark Natural Foods and Whole Foods selling those, niche products. Well, it's even happening at Walmart, not to the same degree at an ONF or a Whole Foods. But we at a chain drugstore noticed our competitors weren't doing anything like that in terms of product lines of vitamins that belong to their stores. And we said, you know what? We did some market research and we found out that our customers wanted vitamins with those same attributes. They wanted to put stuff into their body that mimicked the foods they were eating. And so we said, all right, here's an opportunity for us to do something our competitors aren't doing. We've also got some great market research that can help you determine the market size and potential market share that you can capture. And this is important because if there's not a big enough size of the prize for you to get into something, there's no point in it. We've got this great research called BizMiner that we can look at at certain geographies, and it can tell us for small business what the average annual sales is in a particular category. Now, if you know in order to make enough money, you need to be making $600,000 a year, and then in this category, annual sales for mid-sized businesses or small-sized businesses is $200,000 or $100,000. That's not something that's worth, doing anything. We can also see small business share of a number of competitors, and you can say, okay, that's not going to work for me. There's not enough space for me. So those are some of the ways we're going to get into our market research, and Mary Beth touched on that. But this is stuff I saw coming from corporate America with big budgets and was in awe of when I started this job. I was like, we give this out for free. That's unbelievable. But these are the things that you're going to consider and you need to look at wherever you get it, whether you get it from us or get it from other places. These are things, these are numbers, these are analytics that you really need to look at, whether it's boots on the ground market research, which is just as valuable as the numbers that you can get from us to understand, are people going to buy your stuff? That at the end of the day, is somebody going to buy your stuff? If not, probably not the best idea. Next, you need to look at whether or not you want to do this. I left corporate America. I was done. I had run my course with it. And I thought about starting my own consulting company to help small businesses with a part of marketing. And then this opportunity opened with the university. And I thought, okay, that's a great way to see if I want to do this, see if I want to do consulting. And I got into it and I thought, there's a lot of stuff about small business that I do not want to do on my own. I don't want to do this. It's 40 hours a week of whatever your craft is. And then, 40, however many hours a week on top of that of this stuff, which I will go through. Okay, so you're responsible for direct marketing and advertising. That does not mean your social media platform where you set your schedule of whatever your Instagram and your Facebook and your LinkedIn posts. This is coming up with a brand strategy, graphic design, brand colors, a whole strategy identifying your target customer. Because let me, and I'll talk more about this. Not everyone is your customer. A whole marketing strategy, a marketing plan, a budget, and then executing all of that. Now, you can hire this out if you have the budget for it. I'm not saying you have to do it yourself. You can hire it out, but that requires money. And so that might come into your year 2, 3, but otherwise you have to do it yourself. And I don't want to discourage anyone from starting a small business. The point is, these are the things you need to think through before you do it and make sure, yes, we're all well and good. Then you also have to think about managing finances and controlling cash. This is not just bookkeeping and paying your taxes at the end of the year. This is financial analysis. This is looking at your cost of goods consistently and saying, okay, am I paying the right prices for my food costs? Do I need to look at other suppliers? Do I have a seasonal or cyclical business? How do I manage my cash flow to account for that? What are my revenue drivers? What assortment do I need to look at? Do I need to pull certain vitamins from the shelf because they're not selling and replace them with top sellers? You know, you need to, this is not just taxes. This is performing deep dive financial analysis. If you don't like to do this, you need to hire it out. Again, you might be able to pay for that year 2, year 3, but somebody needs to be doing it beginning at the beginning. There's stuff like this when I went through the concept of starting my own business and I'm not bad with my personal finances. I was just like, I don't know that I want to do that. And I've done it in a business, corporate America. This is my favorite example. I love to make these really expensive kale salads. These are like $30 kale salads with all the ingredients, salad dressing from scratch. These at home cost me like $30. No restaurant profitably can make these kale salads with the overhead and labor costs to make them. Not possible. Well, let's assume some restaurant in Fayetteville figures it out. It's not going to happen but let's see somebody happens. And then I'm going to go there Friday, Saturday, Thursday, every night to have this kale salad. Well, actually, I wouldn't even be able to afford it, to be perfectly honest, for as much as it's going to cost. But so this owner thinks, yeah, I've got Lori coming in here. She's paying for this kale salad. We're making a fortune on it. Okay. Well, he talks to his head chef because he's got this regional distributor on this fancy kale. Okay. And the cranberries and the pears and all the things. You know, he's like, yeah, I'm making money on this. Well, he talks to his head chef who tells him, hey, I'm having to toss all this kale and these pears and these cranberries because they're wilted and old and dead by the time they get here. And the guy's like, oh my gosh. So he really looks into the numbers and realizes I'm not making a profit on this. And so he says, all right, I'm gonna have to go to a local distributor. It's a little bit more expensive, but net, I'm making more money on these kale salads when I look at this. And so this is the stuff you're constantly talking to your kitchen manager. You're constantly talking to your chef. You're looking at cocktail napkins. If you have a high-end restaurant with a bar, are you getting the best prices on those? Or do you need to look at a different distributor? You're constantly looking at ways, okay, do we buy a different, cash flow system or inventory system or a different CRM system if we're a service business that can allow a different employee to do a different job so that we can operate more efficiently. This is the stuff that when you're in the shower, you better be thinking about because you're a business owner, not just maybe it pops into your shower if you work corporate America. This better be in your shower. It's also important to place the right person in the right job. For example, we're on a small team. In our team, we're not on an entrepreneur, we're not running our own business, but you've got to have the right people that get along. You've got to have people that are doing the right things that are for their skill set. You've also got to make sure that people mesh well. This says administrative responsibilities. I need to take this out. I'm not even really sure why that's there. But you've got to get the right people in the right groove and in the right job. And then you've also got to find people that are flexible because in small business, things are constantly changing. It's just, you're going to start a business and I'll get into this and week 2, something's going to change. And so you've got to have things to where they're pretty flexible. One of the most important pieces is money. What I tell people when they come to me is I like to spend money on travel. I like to spend money on going out to eat. I'm really into health and wellness, which can be costly. Whatever your stuff is, because it's different for everybody. When this gets up and running, year 2, year 3, when you should be able to take some money out of it, I want you to still be able to spend whatever your stuff like that is. This shouldn't sink up the rest of your life so that you can never spend money on what you want to. So we need to look at the finances. First, you need to look up the startup costs. Okay, this goes from land to buildings down to those cocktail napkins and the little straw that goes into your cocktail or the cranberries and the kale salad. Like we really want to gather everything. Then how much money can you put into this yourself? If you're trying to get bank financing, they want skin in the game. Not only that, but you need to have some money you can put into this. We have a great financial workbook that Beth put together that if you don't mess with the formulas, which is the key thing we have to tell people if they're really good at Excel, that like that's a major rule, that it's really very simple. It's just data entry for our clients. And we spend a lot of time with you making sure you really understand this. And I mean, this is one of the deepest forms of consulting we get into, and it will spit out financial statements that essentially tell you what kind of sales do you have to get, what kind of expenses are you going to have, and what kind of money is that going to spit out at the end of the month, cash flow, and tell you, is this going to make money? And that's, income statements, cash flow statements, and loan amortization tables. But for most people, those are, novel terminology. And that tells us, is this going to make money based on these estimated numbers that should be real numbers? And then you're going to identify funding sources. Are you going to do bank financing? Are you going to do kind of alternative lending sources? Are you going to get money from friends and family? And then you're going to weigh and benefit and see if any of those are possible and really think through them as you go through that. So if you've gone through that, and hopefully you don't feel discouraged, I'm just trying to, explain the realistic things you need to go through because a lot of thinking is important. Then you will work on a business plan, and just going into it, it's not just a narrative, it includes a budget. Ours is great. I see a lot of people come through me who have first worked on something they found on Google, and it's much more complicated than ours, which is really straightforward. People ask me how long it should be. There's no right length. It's just important that the important content is there, and that it's straightforward. Ours is simple. It's really straightforward. It needs to have an executive summary, which we'll get to last, products and services, the market, the people, the industry, operations and management, and the financial component. We don't have a vision statement. All of that vision statement, mission, that may be important when you hire people, so people understand the goals and all of this stuff, the soft stuff about the organization. But for a business plan, this is nuts and bolts. What are we doing? What are we trying to accomplish? And so it's a lot less overwhelming than what you might see elsewhere. So the first thing is products and services. You are going to outline a detailed explanation of your products and services. This is not meant to be fluffy. It is okay to be passionate and have a voice in your business plan, but we want to be straightforward. You also need to explain this in layman's terms. If you have a high-tech product or service, it's really about explaining the problem it solves and the product or service that you're going to use. Because you never know who's going to be reading this. If it's a banker or other investors, they need to be able to quickly understand your product or service without a lot of confusion. You need to explain where you intend to distribute or sell your product. Is this going to be online? Where online? Is this e-commerce? Is this Etsy? Are you going to have a brick and mortar store? And when you explain brick and mortar, tell about this brick and mortar. What is the ambiance? What is it like? Where is it located? Because that is part of the product and service if you have a brick and mortar. You also want to explain your pricing strategy and structure. Strategy involves, okay, is this a Walmart? Is this like the value offering? Is this a Bordino's if we're thinking restaurants? Is this a premium restaurant? And then structure, is this buy in bulk like gasoline, or is this buy by the unit like a tub of peanut butter? And so you really want to get into that. And then give a range of your pricing. You'll get into competitive pricing later, but give a range. You do not need a menu listing of all your prices, but give some idea of what kind of pricing you have. Next, the market. Okay, everyone is not your customer, and you do have competition. That is a fact, 100% a fact. So for these vitamins that we sold, they were primarily women, about 30 to 45 years of age, high income, exercise regularly, like 4 to 6 times a week. They believed in holistic alternative methods of healthcare. They took 3 at least 3 vitamins for healthcare. So that's a description of our target market. That was the singular group of customers. You don't have to have one. You can have 1, 2, or 3 target markets, but you're going to focus your marketing efforts after this one, this singular or secondary target market. Then you're going to have a brand strategy. We were offering the single premium line of vitamins with these specialty attributes at our retailer because people were buying health and beauty products and didn't have to go to a specialty retailer for a separate trip to buy those items. You're also going to do a deep dive into your competitors. You want to know, what is their claim to fame? What are they saying that separates them? What is their pricing strategy? Where are they located? How long have they been in business? What are their products and services? This is really important. What is their pricing? To really understand. This is also going to enable you to really develop your brand strategy, to understand what can you say that really sets you apart. If you don't understand your competitors, you can't really say this sets me apart. You're also going to develop a marketing and sales strategy. And this really involves understanding your target customer and the industry. How are people marketing in an industry? What does your target market respond to? Then you'll make your location decision. We've got fantastic market research that allows you to look at locations. So for example, say you give us an address and we look and we say, okay, 1,000 people bought vitamins in the last 6 months, and there's a CVS, Walgreens, Walmart, all within a 3-mile radius. Probably not the best place to locate a vitamin store. And we can do that with a variety of attributes and locations. I can't name off all of them off the top of my head. It's really kind of a call us and we'll figure it out. But that's really helpful. Industry is really important. We've got great industry research, a variety of reports we can pull that give us industry financials, industry marketing, industry trends, niche opportunities. You really need to understand the sales and marketing and what's driving so you can market competitively. What social media, whether it's direct marketing, whether it's B2B, whether it's sales. For us in vitamins, we weren't regulated by the FDA, but heavily scrutinized. So it really tied our hands behind our back. There was a lot that would be said in the media and by somebody like Dr. Oz, like, this is a weight loss. Well, we couldn't put that on packaging. So what could we? And so that really created some stuff. Finance and regulation. I worked in an industry where state taxes were different for every single state. That really created a lot of issues. Business challenges, what keeps manager up at night? I interviewed with Duracell at one point, and I remember always thinking, okay, things have chargers. What are they going to do? And that's not, there's so many things that are still battery operated, but I remember keeping that being considered. But like, think about regional, shopping local, like organic requires, we get a lot of farmers, organic requires, a lot of extra certification, but it's really, there's a lot of demand right now for it. Industry opportunities. We found out with food, people want to eat those food. They also want to ingest vitamins with the same attributes. This is the one when I tell people they're going to have to do this section of the business plan, people do not get excited at all, but after they do it, they do not complain and they're fine with it. You need to lay out the people in the business and their backgrounds and what they're going to be doing, and what things about their background make them qualified. You can lay out compensation. It's not necessarily a requirement. Organizational charts are helpful. Probably the most important thing is the day-to-day operations, like how's this ship going to sail at a very detailed level. This is the part no one wants to do. When a bank sees your business plan and you're trying to borrow $2 million, they need to know, you know, what you're going to do on day one and by the week or whatever cycle your business runs. This is also helpful to people writing this because as you write out and think through what you're going to do during operations, you're going to realize things you need to buy, ways you could operate more efficiently, somebody else you need to hire, someone you don't need to hire. So it's really helpful. It can help in the financials you're developing. So people don't love it when I tell them, but nobody really complains after they do it. So, and this is all understanding that everything is going to change week 2 in the world of small business. I talked about the financial plan, so I'm not gonna spend a lot of this, but it will go into your business plan. You will lay out your startup costs. You will lay out your financial projections. I have people explain their financing proposal, what they want to borrow, what that is gonna finance, startup expenses, operating capital. Then you'll put 3 years of financial performance from your projections. And that will also go in the business plan. You'll also do an executive summary. You're gonna write the company description, the owners, the location, and then you will summarize in a very high level each component of the business plan. This is 1 to 2 pages, one maybe, and it's going to allow someone to decide if they want to read the rest of your business plan. So it needs to be simple, hit the high points, so it whets the appetite, but it's not your whole business plan, in an executive summary. Okay, so the other thing you need to think about is insurance. Talk to a small business insurance agent. If you can find someone that works in your industry, that is ideal, like someone that does restaurants, somebody that does medical offices, that's great. Anytime you can get an expert, that's ideal. You'll want to talk about property casualty, property insured, physical damage, casualty is bodily injury. General liability protects any issues that affect other people, product liability, any issues that your product causes to someone else. Workers' compensation affects workers if they're injured on the job. Business interruption is important. Let's think about the tornadoes in Rogers. That can be insurance that covers if your business is interrupted for some reason. Key person insurance or life insurance covers insurance. If a key player in the business is injured and incompetent to work, or if they pass away. Personnel, this is really important as a small business. We don't have huge HR teams to allow us to understand all the employment laws, and you don't want to get this wrong. This is something you really want to understand and make sure you get right. You also want to understand the differences between an employee and an independent contractor. They're taxed differently. There's laws you can break here. I am an employee. I get a W-2. Mary Beth has given me this computer. I have hours that I work. Sure, there's some flexibility, but it's pretty straightforward. This is 8 to 5. I get a W-2 every year. There's a process for hiring me. There's a process for firing me. Independent contractors, if they work for us, they bring their own computer. Their hours are more flexible, and they are on a contract basis. It's easier to get rid of them. Cole will talk a little bit more about this. There are proper practices for interviewing, hiring, and firing. There are just discrimination laws associated with that. Personnel manuals and employee handbooks can be really helpful. So people just know how they need to go about managing their work. This can be really great if you have a bigger staff of hourly wage workers. It also makes performance reviews and stuff like that a little bit more straightforward. And people know how to behave on the job when they get some guidance. Also consider employment or temp agencies. They can help with this interviewing process and make it a little bit straightforward. There are also employment attorneys that you can talk to if you have questions. But there's arkansas.gov labor law, so you can get a good understanding on this. And then just to think about the best bosses you've worked for and the worst bosses you've worked for, and you just want to make a good environment for your employees. So you want to know what's the right thing to do and what's not the right thing to do. Home-based, first and foremost, make sure you can operate your business out of your house. You don't want to start doing it and then find out you can't. So planning commission is who you call to make sure about zoning laws. If you have a POA, you need to check with them, make sure it's okay. It can differ by type of business. There are tax advantages of the business use of home. So you can write off, this is a question for a CPA. I don't know this off the top of my head, and I don't put this into my financial projections, but you can write off like a piece of your mortgage, a piece of your utilities based on the square footage of the piece of your home you use for your business. But this is a CPA question, and they can help that with your taxes. You do need to make sure your insurance is appropriate based on your homeowners and renters policies. Something else to consider, mail delivery and telephone. Do you want your customers to know where you live and have your personal phone? You can get a Google phone number, you can get a PO box. This is just something you want to think about. I would not want my customers knowing where I live and have my personal phone. But everybody's different. Marketing your business. We talked about not everybody is your customer, and you do have competition. So that is first and foremost. You need to develop a solid brand and marketing strategy. Your brand strategy is what sets you apart, who your customer is, and why people should believe that. Then you need to develop a marketing strategy that reflects that attracts that consumer and gets the word out about that claim to fame that you're making. You also need to develop a marketing plan. This is so you're not every week doing something different, trying to figure it out. If you've got an annual or even a quarterly marketing plan, you have a plan. It's just easier. Life is better. And then it's, if it needs to be seasonal, it's just standard to do that. You also need to have a budget. You can't be running a business with no budget. Then you've got cash flow issues. It is important to have a website. Most of us Google, if I Google and I see 6 businesses and 3 don't have websites, I go to the one that has a website. It just legitimizes a website. I'm not gonna encourage somebody to go into Chase card 18% debt, but as soon as you have the money to have a website, do it. Make that one of your first purchases. Social media. This goes back to your brand and marketing strategy. Where is your target market on social media? I'm an old lady. I'm not on TikTok, but it's one of the fastest growing social media platforms out there. I'm not saying everybody needs to be on TikTok. If you're marketing to me, probably not. But if you're B2B, LinkedIn is probably best. You need to pick your social media platforms carefully. Otherwise, you're going to be running around like crazy. Don't lose sight of in-person networking. There's a saying, if people like you, trust you, want to get to know you, they're more likely to do business. The Rogers Chamber is a wonderful small business chamber in Northwest Arkansas. There are a ton of networking groups in Northwest Arkansas. People love to network. And so it's a great idea to get out there and network. You just have to ask yourself if it's right for your business. So those are just some of the ways you can market, and you just really have to pick and choose what makes sense for your brand and marketing strategy, and then let that fit into this marketing plan, and all of these will. You just have to be really strategic about what you do, and these are just some of the examples. So with that, I will turn it over to Cole, and I will stop share and let him go on his way.
All right, let me get the share going. Is that working?
It will in a second, probably. It might take a minute.
Can you see it, Lori?
I can't.
You cannot?
No. Mary Beth, is it on multiple screen share?
It is.
Yes, it's on multiple. It should be fine. There you go. Oh,
All right. Oh my goodness. Okay. My name is Cole Henderson. I work at Wright, Lindsey and Jennings, up in our Rogers office. I'm a transactional attorney. I do all things business and a little bit of tax work woven in there. Help people form businesses. Review contracts, buying and selling businesses, estate planning, pretty much anything along those lines. I have to say this is nothing in this presentation is personalized legal advice or intended to be, and you should consult with an attorney or other tax advisor to get personal advice. All right, so today we're really going to talk mainly about entity structure, kind of setting up an entity, choosing what kind of entity fits you. The fact that you guys are here shows that you're on the right track in terms of getting everything in order for your business, and just kind of thinking about the right things. We'll talk a little bit about tax issues that arise and potential benefits associated with certain kind of structures. If time permits, I'll talk a little bit about taking on investment and things to be aware of on that front, and then a little bit just discussing commercial contracts and things of that nature. So the first question, why should I care? The main reason that you should care is to protect your personal assets and limit personal liability. Basically, if you have a business, and something goes wrong, somebody wants to sue your company, you don't want all of your personal assets to be at risk in a lawsuit or anything that gets tangled up in that. In terms of ease of administration, this is particularly important if you have business partners. Having a set business plan on the front end helps immensely. It's, it kind of gets along with the avoid litigation point. If everyone's all on the same page at the beginning, and then inevitably, a lot of times people are no longer friends once the business gets rolling, or they have divergent interests, or just kind of life happens. And so it really helps to hire an attorney on the front end to set that out, in hopes that you don't pay a lot more to attorneys down the road whenever you end up in litigation. Transferability of ownership really gets at, again, if you have business partners, you can set forth certain mechanisms on the front end, whether if your business partner gets divorced or passes away, you don't necessarily, a lot of people don't want to be doing business with their their business partner's ex-spouse. That can kind of get a bit complicated, as you might imagine. Managing cash flows, really just managing your contract terms, which we'll talk about later. Just being aware of those in order to make sure that you're not having to pay your suppliers or vendors within 30 days, and you're not getting paid until 60 or 90 days. That can create some cash flow and management issues. And then finally, protection of intellectual property, a lot more kind of pertinent to certain types of businesses, but in essence, you just want to make sure that you have contracts that make it clear, if you have developers or other service providers that are developing IP, you want to make sure that the company owns whatever is produced. Particularly important if down the road you are interested in selling, bringing in investors. It's very important that your ND is the actual owner of the IP that it uses, and that can cause an issue down the road if it is not. So structuring your business, and this is a little bit misleading, but there's kind of 4 basic structure types. The first 2 are more of a lack of structure. Corporations, which I'll get into the distinction between S corporations and C corporations. That's where it's a little bit of a misnomer, but corporations and LLCs exist because our legislature passed laws saying that they exist. And if you take anything away from this presentation today, I would say it should be that you do not want to be a sole proprietorship or a general partnership. I would avoid it at all costs. So sole proprietorships, here's little Timmy. He did not come to us, and so he didn't form an LLC. He is therefore a sole proprietor because he is a person engaging in a business activity for profit. Timmy and his business are not separate, and his assets are certainly at risk. If he were to poison the neighborhood with his lemonade, anybody could basically sue him for his bike, his candy, his playing cards, whatever assets he has. The perk to this is that it's very easy because there's basically no administration. It's cheap. There's really no rules governing this. However, there are no benefits whatsoever. A general partnership, this is the same idea as a sole proprietorship, except that it is more than one owner engaging in business activity for profit. Again, it's easy to create, cheap to create, but no protection, no benefits. Commingling assets doesn't really matter as much because, again, it's basically just treated as though these 2 people are individually doing business. It's not separate from owners, so you don't get that liability protection. You can now be sued. Little Timmy can be sued for the actions of his partners. and his assets would also be at risk. In that scenario, you essentially just do not want to be a general partnership if if one of his partners goes to get more lemons on their bike and causes a wreck. Now Timmy's personal assets are also at risk. C corporation. So the rest of this presentation is really going to be more of like an actual entity that's formed that provides protections, has benefits, and is not a sole proprietorship or a general partnership. So a C corporation is kind of the tried and true way of doing business that people did long before LLCs existed. LLCs didn't exist in Arkansas until 1993 when our legislature passed the law. Before then, C corporations were basically what everyone used. The benefits are there's plenty of laws, a lot of case laws developed over time because historically this has been used by pretty much everybody before LLCs became so popular. You form a C corporation by or at a state level, it's really just a corporation. A C corporation is more of a tax classification, but you form a C corp by filing articles of incorporation with the Secretary of State. That's going to require you to list the number of shares, any classes of shares that your corporation may have, any par value of those shares. So there's kind of a separation of powers in a C corp. There's shareholders, which are the owners. They don't have really any duties or responsibilities other than that they're supposed to meet once a year. They appoint the board of directors. The board of directors then appoints officers who manage the day-to-day conduct of the business. This is typically a lot for a solo owner to administer. There's a lot more documentation and formalities that are required of corporations. The bylaws are a boring document, but they basically govern administrative matters, kind of dictate when meetings are held, how voting occurs, things of those nature. Let's see. There's annual filings and fees to the state, and you'll see that that's a common theme with any of these entities that are formed with the filing with the Secretary of State. You're going to pay a franchise tax fee every year for the benefit of doing business in Arkansas. Corporations now, as opposed to a sole proprietorship or a general partnership, it's important to maintain separate accounts, separate bank accounts, separate records, to kind of ensure that courts, in the event that you get sued, will respect this limitation of liability. Because if you don't observe these formalities that are required by the law, then the court's not going to give you the same protection of your personal assets. The final thing on C corps is a lot of times you'll hear that you don't want to be this because of the concept of double taxation. Most small businesses are not C corps. All publicly traded companies are for tax purposes. And this double taxation concept really refers to, in a sense, the C corporation makes profit. Say it makes $100,000 of profit in a year. The corporation itself pays, as of right now, a 21% flat tax rate on that $100,000 of profit. Then there's $79,000, say, left over after you pay those taxes. Then any shareholders that receive a distribution, a lot of times you'll hear a dividend. Anytime that the shareholder receives a distribution from the corporation of those remaining profits, then the shareholders pay tax at their marginal tax rate, their individual rate. And so that's kind of the concept of double taxation that you'll hear a lot. And a reason that a lot of people avoid C corps, although at the current tax levels right now, it's around a combined like 35% tax rate. It used to be much higher before 2017 and could potentially go back up after 2025 if Congress doesn't act, but we'll see how all that shakes out. S corporations, this kind of requires us to distinguish between legal aspects and formalities versus tax aspects and classifications. An S corporation is a designation from the IRS. So it's if your entity wants to be an S corp, you file an election with the IRS to be designated as such. There's no double taxation in an S corp because it's technically a pass-through entity, much like a partnership or a disregarded entity would be. So basically an S corp is just going to file. They're not going to pay any corporate level tax. They do file an information return that basically kind of shows all the same things that a corporate tax return would show. And then the profits and losses pass through to the shareholders, much like any other pass through entity. And then ultimately is reported on the shareholders' tax returns. These are, a lot of accountants will tell you you want to be an S corp, and for a lot of entities it is beneficial and it's great. But we have to point out certain kind of rigid formalities that are required of S corps that may not fit every entity's goals and kind of the conduct of their business. That being said, I mean, the biggest benefit of an S corp is saving on self-employment tax. So when you're a W-2 employee, you pay half of the payroll tax, and your employer pays the other half. But when you're self-employed, as in you're not an S corp or you're not a C corp, then you pay both halves of that payroll tax. And so there can be some tax savings there by electing to be an S corp. There are the restrictions that I mentioned. You can't basically, absent a minor exception that is beyond the scope of this discussion, you can't have entity shareholders. And so every shareholder has to be a U.S. individual, which is kind of a big turnoff to a lot of people seeking a lot of investors, whether it's private equity or venture capital. Most of those types of investors are going to want to invest by way of an entity and not in their individual capacities. There's also a restriction that it can get very complicated, but it's basically the fact that an S corp can only have one class of stock. And so this reduces, a lot of flexibility in the sense that a lot of investors, especially venture capital and private equity, they're going to want to, if they invest, they're going to want to negotiate preferences where they get paid out first. And things of that nature. That's not available in an S corp. And there's things you can do to convert, later down the road. If you really think that in the next, several years that you're going to want a significant investment, there's things you can do. And the last thing that we tend to counsel people away from an S corp is if you own real estate. Real property is basically impossible to get out of. If it appreciates, it goes up in value over time. It's practically impossible to get out of an S corp without triggering taxable gain, whether you sell it or not. And so that's something that we always have to advise our clients if they're planning on owning any real property in their company. LLCs are by far and away the most popular entity right now. That's what I form on a daily basis for most of our clients. They're very flexible. So I mentioned that LLCs didn't exist until 1993 in Arkansas. Our current tax code that we use was enacted in 1986, which is 7 years before LLCs were invented. So they're not mentioned in our tax code. They are not a tax classification. It's a legal vehicle. An LLC can be taxed as either a disregarded entity if it's one owner and no elections are made. That's the default. If there's more than one owner and no elections are made, the default is it's taxed as a partnership. And then you can file an election to be taxed as an S corp, as I mentioned, or a C corp. And that election is just a simple form. It's not technically difficult to carry out. If you do elect to be an S corp, you're kind of stuck with that for 5 years. Assuming that it was not your initial classification whenever you first form your entity. So there, you definitely want to seek advice if you're thinking of making an election and you might have different goals in the future. If you want to be an S corp, as soon as you form your LLC, you have about 2.5 months to file that election for if you want it to be effective in that current year or upon your formation. LLCs are easy to set up. There's not that many formalities. We charge like probably half to form an LLC of what we would charge to form a corporation, because there's basically 2 documents. There's a certificate of organization, which is basically a 1-pager that you form the entity with, that you file with the Secretary of State, and there's an operating agreement that kind of governs all of the affairs. Whereas a corporation, we have, about 8 documents or so to get everything documented and up and running. Owners in an LLC are called members. Management is either member managed or manager managed. The default, if you don't have an operating agreement, or you don't have an operating agreement that says you're manager managed, is that you are member managed. We tend to form manager managed LLCs for a variety of reasons, but one of them being if the historical owners or the founding members ever want to give employees a little bit of equity to incentivize them to stay with the company or something, but they don't necessarily want them to have authority to bind the company unilaterally in a contract or buying something on behalf of the entity. That's where it's beneficial to have managers who have most of the authority to conduct day-to-day affairs and contract on behalf of the business, and then have members that are just members that just have lesser rights in terms of making decisions. LLCs that don't they're very flexible. LLCs that don't elect to be an S corp have no ownership restrictions, so that's great, and that's why a lot of people choose this route. Limited liability, as I mentioned earlier, generally a benefit, although it's not absolute. There's still exceptions for instance, fraud, intentional misconduct, gross negligence, or self-dealing. You're not going to get the benefit of limited liability if you're actively defrauding somebody or things of that nature, which logically follows. But I just have to mention that it's not absolute. In addition, most banks that give you financing are going to want a personal guarantee. So in that regard, your limited liability is in itself limited. Limited liability is a gift from our legislature, and if you abuse it, I mentioned earlier, if you don't observe the formalities, if you don't have separate records from your individual, if you're using the company's funds to pay your personal expenses, or vice versa, you're commingling funds. If you get sued, the court is not going to give you this benefit of limited liability if you're not compliant with the laws. And most frequently, you'd see that in like I said, just commingling assets or expenses. And sometimes that can be as simple as taking the extra step of transferring funds from your LLC's account to your personal account, and then paying those personal expenses. Not only is it a good, clean accounting practice, but it helps you kind of steer clear of this whole idea of what you might hear piercing the corporate veil, which is kind of what I just mentioned. So this is just kind of for your slides, but this is just kind of a comparison of the different terminology and documents required for each type of entity, what you have to file, what they're called, kind of the names of the owners and how they might be taxed, and things of that nature. Some things you want to think about prior to forming your entity. First thing is name availability. So you want to come up with a name that you want to use, and you want to search the Secretary of State's website to see if it's available. If somebody else has a name that's not distinguishable from the name that you want to use, the Secretary of State's not going to let you use it. And even so, there's kind of 2 hurdles. Even if they do allow you to use it, the Secretary of State, that doesn't necessarily mean that you're kind of free to use it wherever. There's this whole idea of trademark infringement as well, which is essentially gets down to, is someone else in my industry using the same name? You want to make sure that someone else isn't using it, because when you start up and you're not really generating much revenue, nobody really cares. However, when you get successful and you start making a name for yourself, if you are infringing on somebody's trademark or using the same name in the same industry, the standard is kind of confusion of the consumer. So would a consumer be confused? And my colleague who used to give this presentation always uses the example of you can, if nobody's using the name McDonald's for a restaurant in Arkansas, you could technically use it. But when you get successful, you are absolutely going to get a cease and desist. But if you were to open a McDonald's furniture company, that wouldn't nobody's going to walk into a McDonald's furniture company and think that they're getting a cheeseburger. So that would not necessarily confuse a consumer. As I mentioned, you're going to want to determine your tax status. Definitely speak with an attorney and definitely a CPA or accountant. I mean, there's a good CPA or accountant is very valuable. I mean, we work with them, we defer to them for a variety of matters with our clients all the time. Definitely, establish a relationship with one. A good CPA is going to save you more money than they're going to cost in the long run. And it's, particularly important whenever you have business partners to keep everything clean and tidy. Key questions for founders. I kind of alluded to this earlier, but if one founder leaves, does the company or the other founder that's remaining with the company have the right to buy that founder's shares back? At what price? These are things you can set out on the front end to avoid kind of disputes later on. A lot of people think, just because someone leaves the company that their equity just vanishes, and that is not the case. And it sounds like a kind of a common sense thing, but it happens all the time, and we really have to deal with this. Not necessarily if somebody has a good document on the front end, but people that didn't really want to, or maybe weren't able to spend the time and money to get solid documents in place on the front end, and now things have gone haywire, and they don't have clear documentation that shows what should happen. In this scenario, a lot of times, in entrepreneurship programs, people just have divergent interests over time. People become less involved. They may move away. We draft documents to address, forfeiture of ownership, or the company or other shareholders or members having a right of first refusal to buy that before the departing member, sells it to someone else. And what I mentioned earlier about, owners giving employees equity, a lot of times you want to make sure that you tie their right to own equity in the company to their time of service. Whereas, if they're terminated, you don't want to continue working with them in most cases. And so you want to have a mechanism in place to be able to buy them out. And I will say a final note on this. You also want to have, something in place to dictate how you'll decide if you want to sell a business. If somebody comes to the table and says they want to pay you a lot of money, how is that decided? Can the majority basically accept it and have what they call a drag along right, which means that any minority owner has to sell on those same terms, things of that nature. You want to have that in place so you don't have disagreement down the road. And finally, a lot of people come to us and want to do a 50-50, business, which, makes a lot of sense in terms of people wanting to be equal, people wanting to put up equal amounts of money. However, there's no, without documentation in place that addresses this, the law does not provide a good dispute mechanism, a dispute resolution mechanism rather, for a 50-50 business. So, we draft documents generally. If somebody's going to be 50-50, that's fine, but you have to think about a situation where the two 50-50 owners can't come to an agreement on something, and you've either got to have a tiebreaker. You got to give that decision, the tiebreaker decision to somebody, or you've got to build in a mechanism that kind of takes care of a dispute where they just cannot come to terms. It may be, we a lot of times we draft a provision that basically says, if the two parties cannot reconcile, one party gets to offer a set price for their 50% and say, okay, other owner, buy me out at this price. The other owner then has the ability to either sell their 50% at the price that the initiating owner offered their shares, which prevents the person who first sends the offer from making a egregiously overpriced offer, because then they would have to buy the other owner out at that inflated price, or they can accept the offer and buy that person out. So all that to say, there's things you can do to address it, but if you don't address it, there's no good way to resolve these types of disputes. On taxes, you need to be aware of all the different kinds of taxes you're going to be potentially subject to as a business owner. A lot of times you're going to be subject to sales and use taxes at the state level, state and federal income taxes, self-employment tax if you're a pass-through entity that's not a S corp or a corporation. And that's as mentioned, when you're self-employed, you're the employer and the employee, so that's roughly 7.5% versus 15%. Withholding taxes on employee wages if you have employees, franchise taxes, which are generally about $150 a year to do business in Arkansas. And they are just miscellaneous that, if you own real property, property taxes, just things to be aware of going in. Investments, this is probably a little bit overboard for today's discussion, but I just want to kind of provide a little bit of insight into the future if you do seek investment and that's on your horizon. Equity investments are probably the most typical way that entities seek capital. There's kind of different series. You'll hear a series seed, which is generally like a friends and family round, so we call it, where you this is your first stage of soliciting capital from friends, family, people that believe in you, that aren't strangers. Investors are going to pay a set amount of money, and they're going to receive a set percentage of equity ownership based on the valuation of the company. After that, Series A, Series B on, that's generally when you get kind of further and further attenuated from your network, and you get outside investors that are going to come in. They're going to want to negotiate terms on top of what the existing owners have. So they may negotiate for certain voting rights or veto rights on corporate actions. They might want dividend rights that are preferential, that they get paid out before anybody else gets paid. And so just know that those terms kind of build on each other. And so anytime that you have separate series of capital investment, you're basically going to have to offer those new series something else on top of to incentivize them to invest money in your company. And then convertible notes and safes, that you'll I set that in there for your notes, but those are a little more complicated, just ways of seeking investment that are a little bit different from equity. And if you're in that position, you've got good problems on your hands. And then all that to say, securities compliance. If you are thinking about seeking investment, definitely seek out an attorney that's experienced and knows what they're talking about, because securities laws are very complicated, and they have significant consequences if you don't follow them. All the different ways of raising capital are classified as securities by the SEC, and there are steep penalties. If you run afoul of these, investors may have rescission rights, which means they can demand their money back that they invested, which is a problem, because a lot of times these companies that are seeking investment don't have the money anymore, because they came to you in the first place to get investment because they needed the money, and they've probably already spent it. And so that can be a huge problem. And personal liability for directors, officers who participate in an offering that runs afoul of these laws can be personally liable. And so beware of that. As Lori mentioned earlier, you're going to run into employee issues, whether, just kind of determining how you want to go about hiring service providers, whether you want to have independent contractors versus employees. There's, multi-factor tests that go into this. It's not just because you have a contract that says independent contractor agreement at the top or something. That is not determinative. There's many factors that go into, control that the employer has versus the employee or independent contractor, freedom to do other work, as Lori mentioned, materials that may be provided. So just something to certainly, we have a whole labor and employment team here that I don't really dabble. I call them whenever somebody has employment law issues. They draft employee handbooks and policies for the workplace, deal with investigations, internal investigations, federal investigations, what have you. So that's just something to be mindful of. You want to have good documents in place, non-disclosures and confidentiality agreements, for example, if you don't want employees sharing information of the company when they leave or even while they're there, as well as non-solicitations and restrictive covenants. You don't want somebody to leave, start up their own thing and take all your clients or all your employees. And so a lot of times businesses will have a non-solicits in place. They'll have restrictive covenants, which you might hear, a non-compete agreement. Those are popular, although enforceability of those is kind of subject to a federal action that's been kind of set in place right now that's being challenged legally. But as of now, non-competes are still technically enforceable. Small business contracts, just things you're gonna encounter, leases, other commercial contracts with vendors, suppliers, customers. I've already mentioned, employment and non-disclosure agreements. You may have privacy policies in terms of use. If you're, collecting customer data, we have employer attorneys that do that specifically. Shareholder agreement, buy-sell agreements, your operating agreement. These are just all different documents that are very, very important that you want to have. Ideally, you would have an attorney prepare and review. Commercial real estate leases, have to highlight this because this is we deal with these all the time. They're very disputed. Nobody ever really reads them. They just want to get in there and start running their business. So they don't really read them. And these are a large source of dispute. And so would certainly encourage you, if you get presented with a lease, to have an attorney review it, because there's so many different issues that can get kind of just caught up in the weeds and cause disagreement down the road. As I mentioned, in your commercial contracts, you want to nail down payment terms, make sure that your cash flows are in order, that you're not floating cash flows for an extended period of time that can put you in a really, really bad position. Ownership of IP, I mentioned that. And a lot of startups have like a master services agreement, and then they have standard of work or a statement of work that or exhibits, that kind of stem off of those and operate on their own, but are derivative of master service agreements. You just want to make sure that you have somebody review those and make sure that they kind of cooperate with each other, that they don't conflict. That can cause a lot of confusion that we see a lot of times. And knowing if and how you can terminate and how the other party can terminate a contract, and any liability, fees, penalties that may be associated with termination. Very important. That's something that we review all the time, whether it's in a transaction or just a customer or a client kind of thinking about entering into a contract with somebody. Those are very important terms. Non-disclosures, I've kind of already discussed this, so I won't get into that anymore. Buy-sell agreements as well. I just kind of discuss this with key considerations for founders. Make sure that you have processes set in place that dictate how these situations are dealt with if somebody wants to leave or somebody wants to sell their ownership. And that is all I have. Thank you all for listening to what I hope was somewhat informative. And I'll turn it over back to Lori and Mary Beth, maybe.
Yeah. Hey, Cole, I had a quick question, just because when I see the issues on leases, that is one of my biggest questions. It's not just everybody in our office is constantly hearing from our clients on they're signing these leases before paying any really close attention as to what's in there. And then inevitably it's a year and a half later. And I had one, I can't tell you how many scenarios I've had, but one scenario was HVAC goes out. My client was like 70% of the structure. So he ended up having to pay for the entire HVAC replacement. And of course, small business, he didn't really have that budgeted in. And he was trying to argue, but he loved his space. He loved that space and he wanted to be in that space so much he couldn't stand it. So nobody reviewed the lease, nobody did anything. And then all of a sudden he was strapped with this huge amount. I mean, in his mind, what was a crazy amount of money in order to buy a new HVAC system. What challenges do you see with these typical small businesses who maybe have 1 to 20 employees who, what are they signing that you see that they really didn't realize that they were getting themselves into?
Yeah, that's a great question. And you pointed out a huge one. A huge one is really maintenance and repair responsibilities. Because like one thing that we run into a lot of times, and it depends on what kind of building you're in. Like a big one is say a water leak. Like if you're in the bottom floor of a building, those can get really complicated in terms of tracing where it even came from, whose responsibility it is to maintain what. I mean, even if it's a single story building, okay, whose responsibility is it to maintain the structural components, the roof? How quickly does the landlord, if it's their responsibility, how quickly do they have to commence repairs? How are the costs shared? Like things like that are massive. And as you mentioned, HVAC, like just very different. You know, if it's a restaurant, it may be, you know, vent hoods or like, there's just so many, it can depend on what conduct of business you have. It can depend on what kind of building that you're in. It can also depend on what landlord you're dealing with, you know, I mean, some are willing to negotiate and others are just not. And eventually it becomes a question of how, you know, how much risk are you willing to take on with these terms if they're not willing to negotiate to get into that spot that they have that you really want, because things are not going to go perfect. There's going to be something that goes wrong every time, especially in a lease. So that's one of the biggest ones. The other one I'll say is, especially if you're in there with multiple other tenants or there's common areas, spelling out how the common area expenses or the operating expenses are calculated and how they can be escalated, how they can be disputed. Like, that's a huge one, because sometimes we get these leases where the landlord, you know, everything, oh, it's, you know, it's $3.60 a square foot, you know, and then year one goes by and they get a, you know, a reconciliation or a, you know, an estimate of the next year's, and they've gone up immensely. And it's like, okay, well, everybody goes back to, everyone goes back to this document, and that's what governs. And if that doesn't have a limitation on a percentage increase, you know, year over year, or has some other, because a lot of these leases are very landlord friendly because that's who drafts them, and most of the time people don't read them. That's a huge one. It's just because those provisions get really convoluted of like, oh, what goes into the calculation of common area expenses, you know, what goes into operating expenses. It could be, you know, depending on if it's triple net, you know, it may be insurance, taxes, it may be property management, it may be accounting. Like, there's so many things that go into that. That's the other, I'd say, biggest one. And then just, you know, termination, how to get out of it. A lot of people are not pleased with their situation, and believe it or not, landlords do not make, they're not going to make it easy for you to get out of a lease because they want that cash flow. So those are probably the three like primary areas where I just see the biggest kind of issues typically.
That's really helpful. Hey, Megan, you ready to go?
I think we have one more question for
Oh, good,
Cole.
thank you. Sorry about that.
That's okay.
Shanda's asking you, Cole, can you speak to renting your own property as an LLC? Is it advisable to have a lawyer involved in reclassifying or rezoning a property for business use?
Okay, so in terms of renting your own property, I'm assuming that just means like owning a property in an LLC and renting it to a tenant. Is that?
Hey, Shanda, if you can you unmute and speak?
I think what she means is it's right now it's not for business, reclassifying the property for business use. Can you do that? Is that right?
And she says renting it back to herself.
I mean, oh, sorry.
She's trying
Yeah,
to
I mean,
unmute, sorry.
that's kind of that's a very general question. I mean, you know,
I would think it's first, is it zoned for commercial use?
right.
Is what I would think.
And I mean, yes, I would generally say, you know, I mean, a lot of people do that without an attorney. I mean, I know tons of people that own property and go to city hearings that, you know, deal with rezoning. I don't really deal with that hardly ever in my practice. And so I can't really, I'm sure there's attorneys that specialize in it and are super helpful. I
I
can't really
think
speak
if
for it.
she says it has the potential to be reclassified, I would ask an agent, but if it can be reclassified and zoned, that's the biggest thing. Can it be zoned for commercial use? Maybe a real estate.
Yeah. I mean, so, I mean, a lot of people do it by just, you know, dealing with, I mean, I don't think that you have to have an attorney to deal with that. I know people that do it all the time with rental properties or you know.
And yes, rental properties can be LLCs. And I think you can probably lease it to yourself, but ask a real estate attorney, I would think.
Yeah, I mean, we do that. I think I would need a little bit more context to like I mean, there's nothing that prevents you from leasing anything to yourself, you know, If you own a property in an LLC, I mean, I think maybe the question's getting more at like legitimizing, deductions and things of that nature. And that's a whole separate issue. But I mean, to answer the question, generally, yes. I mean, there's no prohibition on, renting property to yourself. A lot of people do, a ton of entities do that where they have a business and then they own the real property that, in which the business operates in a separate entity. And it may be for the thing that I brought up earlier where they want to have an S corp. They want to conduct their business as an S corp so that they can save money on self-employment taxes, but they don't want to hold that real estate in the S corp because they don't want to trigger, taxable gain if they don't sell it. And so they'll have two separate entities, which are, they own both of them. But all that to say, I think it's important to have a lease agreement in place, even if it's with yourself. Have a document. It just legitimizes the transaction. If the IRS were to ever come look at anything, you want to have a written agreement, which again kind of gets back to the whole, observing formalities so that you prevent, a court or the IRS or somebody, kind of merging those two entities together and saying you're not treating these as separate. You're leasing it to yourself, but you don't even have a document in place, So all that to say, yes, you can do it.
That was really helpful, Cole. Thank you.
I don't know if it was or not, but
Very much. No, very much so. Okay, Megan, let's turn this over to you.
All right. I just shared my screen. Oh, we don't want to go there. Hold on 1 second. You get me back to where I need to go. I think it just closed, or it's actually right by his phone. Here.
Well, I know we're not picking up the other, so it should.
Okay.
This is.
Everything's
Yeah.
in. Oh, there you go. There we go. You guys see that screen okay? All right, perfect. Well, yeah, my name is Meagan Locke. I'm a senior banker here with Bank of America. You probably see James Norman under the name. I'm just borrowing his computer. He's helping me with the mouse and clicking things. So, but he is a commercial banker with Bank of America as well. I'm really excited to be going through this workshop with everyone today, the Better Money Habits Small Business Workshop. I've been with Bank of America for almost 10 years, since the beginning of my career. I've been assisting many small business clients with establishing and growing their business, offering advice and solutions to help them reach their goals. I know when my mom started taking over her own small business, a bakery actually, she came to me with a lot of questions. So many phone calls were had then. But I was really proud to lend my expertise to her and just be able to be there to support her journey. So I do hope that this presentation offers the same to all of you. All right, just some important information here. All right, so just what we're going to go over today, the agenda is just understanding the main elements of business-related finances, such as budgeting, saving, borrowing needs, managing your debt. We'll also discuss common reasons why small businesses fail and how to set yourself up for success. All right. So launching your business is only the first step. As an entrepreneur, you need to continually manage multiple aspects of your business so that it will grow and you can achieve financial success. This module will highlight the steps necessary to manage business finances, including borrowing money, how to build business credit, and why it's prudent to separate personal from business. We'll also talk about common mistakes small business owners make and how to avoid them. So we're going to start with just managing business finances. So managing your business finances is similar to managing your personal finances. You don't need to be an accountant, but you do need to be serious, diligent, and invested in the outcome. To manage your business finances, you should create a budget that is separate from your personal budget, understand how to save for your business, and know how to manage business debt. So we're going to put these topics into context of running a small business. So first, let's talk about budgeting for your business. So I don't know if everyone got this. I think everyone may have received this. This is just an example of a worksheet for a operating budget. So creating a business budget is pretty straightforward. So in simple terms, you'll need to record all your income and all your business expenses for a few months, and then use those figures to estimate what your income and expenses will be for the next few months or for the year. And for small businesses, you will most likely create what is called an operating budget. You project your monthly revenue on the basis of past patterns or what you have invoiced. And you project those anticipated costs of all your expenses, such as your food, supplies, labor, insurance, and costs of marketing and communication. Then you'll reconcile those projections with real numbers once they're available. So make your budget lean, stay frugal, and be realistic. If you're going to ask for a loan, you're going to have to share your operating agreement with a prospective lender to demonstrate that you know exactly what the business finances are and that you'll have the income to cover the cost of the loan. And most important, perhaps, is to review your operating budget regularly and adjust your spending to ensure that you don't have more going out that is coming in. And if the times are good, you might be able to save some more money and pay on a business loan or maybe buy some new equipment. If the times are more lean, then you'll know before the situation gets out of control, and then you can adjust accordingly. It's important to remember that there isn't one standard budget. Your budget will be tailored to the needs of your business and the stage your business is in. For example, if your business is in if your business is in expansion mode and you have a lot of anticipated one-time capital costs, such as production equipment or building improvements, then your budget will be different from that of a small business owner who is providing a service or creating products in their home in the early stages of their business. All right. You also may look into some software programs that may help you create and manage your business budget. It can save you a lot of the stress and investment of time required by record keeping, as it automates many tasks. It also reduces the potential for human error and increases the accuracy of forecasting. Here are some programs that you may find valuable for your business. And at some point, you may also want to consider outsourcing this function to an accountant. The second step in manage your business finances is start saving. Having a buffer for lean times and emergencies is every bit as important for your business as it is for your personal life. How do you cover expenditures when your income is delayed? The movement of funds into your business in and out is called cash flow. Many businesses face problems when it comes to cash flow. It's vital to know whether you have a soft spot in your cash flow and to be prepared. You might experience non-payment of invoices, the loss of a client, or seasonal declines, but your suppliers and staff still need to be paid. You also need to plan for emergencies and prepare for downturns by building up an income buffer. Another reason to save is for future purchases, such as maybe expanding the business by buying new equipment or upgrading your technology. If you're repeatedly dipping into your income buffer, that could indicate a significant problem, and you'll need to re-examine your budget, your income, and also your payment policies. The third and final better money management tip is to manage your debt. Your business is subject to the same debt pros and cons as the debt in your personal life. Some types of debt may be worthwhile investment for future growth, while others, such as high credit card balances on which you can pay only the minimum each month, can be debilitating. Be cautious when it comes to taking on debt. As a sole proprietor or a partner of a business, you are liable for any debt your business accumulates. When it comes to borrowing, Keep these guidelines in mind. Borrow with care, only if you must and as little as you can. Make sure you understand the loan's terms, interest rate, and repayment options before signing the papers. And calculate what you will be obligated to pay monthly so that you know what to expect, and make sure your business income can support your obligations. And also include your loan payments in your budget. And another thing you can do is work with a financial professional if the amount that you're wanting to borrow is substantial. When you use a credit card responsibly, it can help develop good money habits and improve your credit score. You can get a secure credit card by paying, for example, $500 to $1,000 upfront as collateral. You can't use that money to make payments on your card, and you can't change more than what you put in collateral. But if you use the card responsibly and make payments on time, you'll build strong credit history and demonstrate to lenders that you are a good credit risk. And if you use a secured card, make sure that the activity that you're doing is reported back to major credit bureaus so that you get credit for responsible behavior. Your payment history is the single most important factor in your credit score. It accounts for 35% of your overall score. A good credit score will be beneficial if you apply for loans in the future. Now, there are downsides to having that secured credit card, as if you don't make your payments on time, your business credit will fall. Many secure credit cards have higher interest rates than unsecured credit cards. And there may be additional charges such as late payments or annual fees on those secured credit cards. If you do have good personal credit and a business plan, you may also be eligible for a standard unsecured credit card. Know the terms of any credit card agreement before you sign anything. Credit cards are a convenient way to pay business expenses, but using them does come with obligations. And you can find valuable information about credit and lending on our Bank of America Small Business Community website, and I'll share that at the end of the module. There may come a time when a business credit card is not sufficient to cover your business needs. That's when borrowing money could be an option. Any lender will want to know details about your business. Your business plan is an important document for lenders to review. It can show that you have a well thought out strategy. You may not realize it, but your personal credit can impact whether your business can borrow money as well as how much you can receive. So the first step in borrowing is to make sure that your personal debt is in order. Request your credit score, and if necessary, take steps to improve it before approaching a lender. Your payment history on a business credit card can also have an impact on your borrowing. A lender will check to see whether you consistently make timely payments. And finally, it's important to fully understand why you might need to borrow money for your business. Use your budget and your financial statements to help you understand what you're spending money on and what your future needs will be. Sorry, I clicked a little too far ahead. Okay, so there are several ways that you can borrow money for your business. A business line of credit is a type of small business loan that is more flexible than a traditional business loan. With a business line of credit, you are allowed to borrow up to a certain limit, say $100,000, but you pay interest only on the portion of money that you actually borrow. You do not receive a lump sum. Rather, you draw on the line of credit and repay the funds as needed, as long as you don't exceed the limit. In that regard, it is similar to a credit card. A line of credit is also good for short-term funding, such as managing your cash flow or covering unexpected expenses. Now, one loan option is a traditional business loan from the bank or other lender. However, this might be difficult to secure if your business is less than 2 years old, as it can take a while for a business to qualify. You may also want to consider a non-traditional small business loan, such as crowdsourcing or a microloan. Crowdsourcing or crowdfunding is when you reach out to the masses to request funding via an online campaign. Kickstarter is an example of a crowdsourcing platform. Another is Kiva, and it's funded by people who go online and donate specifically to your business. Crowdsourcing may be a viable option if you are up to date on technology, have a product or service that entices the general public, or offers rewards that attract contributors. Microloans are another non-traditional loan option. These are small, short-term loans that usually have lower interest rates and lower minimum borrowing amounts. Typically, these loans are in the thousands of dollars, but the guidelines are more relaxed, and the loans are often easier to get than traditional business loans are. Lending decisions are not based solely on credit score, bank balance, and collateralization ability. Microlenders look at the bigger picture, including your experience, passion, and opportunities. They can be a good source of working capital, inventory or supplies, furniture or fixtures, machinery or equipment. And then also there's the Small Business Administration, known as the SBA. They're a great resource when looking for loan options. Although it doesn't actually do the lending, it sets guidelines for loans made by its partner lenders, community development organizations, and microlending institutions. It also provides a guarantee to a lender that if a borrower defaults on the loan, the SBA will pay the loan off. All right. And then to help consumers who aren't served by the traditional banking systems, Congress did create community development banking in 1994. Because CDFIs can obtain funding from U.S. Treasury grants, businesses and private sources, they are often able to offer low-cost mortgages for first-time homebuyers and loans for small businesses. Banks, credit unions, loan funds, microlenders, or venture capitalists may serve as CDFIs. CDFIs rely less on credit scores than financial institutions do and emphasize developing long-term relationships with members of the community. Some make lending to small business owned by minorities and women a priority. Typically, the loans are in the thousands, but guidelines are relaxed, so the loans are easier to get than traditional loans are. Search out for CDFIs in your geographic area online. Talk to them about the requirements and whether you might qualify. Some might require you to take a business course before applying, and then also be prepared to discuss how the loan would benefit your business and your community. Okay, there we go. All right, so the second thing that we want to talk about are just some common mistakes that small business owners make and how to avoid them. So despite your best efforts, sometimes your small business may fail. What are some of the biggest issues that entrepreneurs may face? In this section, we'll highlight six common reasons as outlined by the National Federation of Independent Businesses why small businesses fail, and give you some tips on how to guard against them. All right, reason one. So one big reason a small business might fail is because the entrepreneur does not take time to plan and assumes his or her passion will lead to success. To be an effective business owner, you need to take the time to inventory your personal and financial states to determine the best time to start your business. You need to understand the differences between having an employee mindset and an entrepreneur mindset, and accept that you may need to change your ways to be successful. And don't skip on writing a comprehensive business plan. You may think you can cheat on this if you are not presenting your plan to lenders, but it's important to consider all aspects of your business, such as the competition, your marketing strategy, and your distribution channels before starting your company. Finally, some entrepreneurs can be overly optimistic about their potential success and neglect to prepare for slowdowns. Be realistic in your budgeting so that you feel in control rather than reactive and stressed about your business finances. Just as small businesses can fail because of lack of planning ahead, they can also fail because the owner didn't do enough research. It's critical that you understand the current and future state of your industry and your market. Investigate your customers' needs and demographics. Look into your competition. What are they offering and what price? What's working for them and what are their challenges? Understand what's unique about what your business offers. Doing proper research is more involved than just a Google search. Put time and effort into speaking with people. You may even need to buy data from a reliable source to get a handle on the demographics and trends.
Hang on, Megan, I hate to interrupt you, but one
Yeah.
quick thing. Remember, that's what we do. That's what we do every day. We provide these services for free. So there's no reason for anybody to pay for anything. As Lori mentioned and put a lot of time into talking about earlier, all of the market research that we have and the access to crazy numbers of databases. So we're the source for that, and we can help with all of that data. There's no reason for any of our clients to go out and pay for anything, because that's what we do every day.
That's amazing. Thank you for that. Thank you for including that. All right.
I want to piggyback on something really great, Megan, that you said about interviewing customers. We have a great format for that called customer discovery that I did not mention. That is a great way to conduct primary research for customers. So we can also help clients do that, which is a form of primary research, because it is important to talk to customers in some cases. So I wanted to add that. So thanks for reminding me about that.
Absolutely. Thanks, Lori. All right. So another reason here that we have is just not getting enough support. So many entrepreneurs feel that they just go at it alone. This is one of the biggest missteps you can make. The most successful entrepreneurs know their strengths and weaknesses and surround themselves with people who complement their skills. Make sure you set up an advisory board of professionals and experts such as lawyers, accountants, experienced entrepreneurs, and bankers. Join social media communities. For instance, a Facebook group that is even somewhat related to your business could be helpful and offer different insights. You can learn a lot about how to run your business by finding out what's on people's minds in related areas. And if you can't find a social media group to join, just go ahead and start one. Maintain contact with your network. It's easy to lose contact with people you're close to once you launch your business because you're so caught up in the day-to-day operations. So be sure to stay connected with them, not only through email, social media sources, but also just getting coffee together and going to an event. Online sources such as Bank of America's small business community website shared at the end of this module will also offer a wealth of information on this topic. And then fourth reason is just insufficient funds. So entrepreneurs need to know their numbers and must regularly check on the health of their business. Reviewing financial statements such as income forecasts, balance sheets, and cash flow projections should be a regular business activity. It should be a habit. To avoid running out of money, overestimate your expenses. It's easy to have unrealistic expectations about the cost of starting and sustaining your business. Be diligent about your savings. Set up automatic transfers into your savings account. Saving just 1% of your income can help you cover an unexpected expense in the future. Take advantage of free checking accounts. Many banks offer these to small business owners to start up time in the hope that their business grows. You'll approach them when you need a credit or a loan. And then finally, make sure that you budget for and make quarterly tax payments to avoid being charged late fees and penalties. And then fifth reason, loan mistakes. So if you need to borrow money for your business, make sure you understand what interest rates are and the fees that you may be charged, and then budget them accordingly. Remember that having good credit as an individual will help you secure a business loan and lower interest rates. And if necessary, take steps to improve your own credit before you apply for a business loan. Be sure to borrow only what you need and think hard before borrowing for operational costs that don't increase revenue. Having more money on hand isn't always the answer, so consider trying to reduce expenses before investigating borrowing needs. Finally, get advice from the professionals before taking the loan. They can offer opinions about whether a loan is necessary and what type of loan is best for your business needs. And the sixth reason, losing focus on cash flow. Cash flow isn't how much you make or how much you're worth. It's how much is coming in and when and how easily accessible it is. Small businesses have a constant inflow and outflow of money, and entrepreneurs need to understand how much money they have available at any given time. If your cash on hand won't cover your bills, you have a cash flow problem. You can manage cash flow by staying on top of record keeping. Be diligent about what money is coming in. Invoice customers promptly and nudge them if they are late in paying. Likewise, properly plan outflows of money such as rent payments, payroll, and utilities. If you don't have a payroll partner, keep a ledger of the dates and the hours your employees work and the amounts and dates they're paid. Schedule a regular time each week to review invoicing and record keeping so that it becomes a habit. If you don't like doing this kind of work, then think about hiring someone to do it for you. Another way to manage your cash flow is to review your loan terms. Perhaps you can get a lower interest rate now that you've been in business longer. Or maybe you can change your payment due dates at the time of the month so you know exactly where your money will be available. Finally, make sure you're not overpaying taxes or paying for duplicate coverage on your insurance. You might be able to find hundreds of dollars a month or even $1,000 in unnecessary spending. Taking the time to manage cash flow is an important responsibility for any business owner. Remember, passion alone will not make you successful. You must be able to manage the administrative side of the business. Otherwise, hire someone to help you. All right, so just some key takeaways. Just consistently managing your business finances by creating that budget, saving and managing your debt, and that will help with your business health overall. 2, consider getting a small business credit card, make purchases for your business. Remember to make timely payments. You don't want to get charged late fees, and you don't want to have to worry about interest charges. 3, small businesses can borrow money in a variety of ways, including a business line of credit, a small business loan, crowdsourcing, those microloans, or the CDFI loan. And then 4, small businesses can often fail for lack of planning, research, lack of support, insufficient funds, loan mistakes, and just not understanding your cash flow needs, or just simply not asking for help when you need it. And then that's it. Now, we do have those additional resources. So a lot of this is on the bettermoneyhabits.com website. But there's also, and also here too, there's a lot of really great videos, quizzes. They're just, you can go down a rabbit hole clicking on things. It provides so much information. And then this one here, the bankofamerica.com/SBR. This is going to be able to provide a lot more resources in regards to like startup loans and stuff like that.
Meagan, thank you so much. One way we could add some of these links to our website, as well as we'll have them on the slides that we're sending out to everybody. So if we have them on our website, that'll be a good resource as well. Thanks again for that good presentation.
Absolutely.
I guess I really don't have anything else left to share, except I'll just tell everybody, thanks again to Bank of America for sponsoring this for us. When we send all the information out to you guys, we'll be able to send you both slide decks as well as contact information and those kind of things, so you can reach out to any of our presenters. Also, remember, we're here to help. A lot of those things that Meagan brought up are what we do every day, is creating everything from a lot of that customer discovery Lori was talking about, and the market research, and the really detailed financial projections. Even one of those slides that Meagan had looked a whole lot like what several of my clients who are on here have already seen, which is as we are working toward 3-year detailed financial projections and cash flow statements. So thanks again to Bank of America. Thanks to our speakers today, Cole, Lori, Meagan. Really appreciate you guys. Anybody who needs us, reach out to us. By the way, for any of our clients in Northwest Arkansas, Remember, we're in downtown Bentonville, and we just now moved into our newest location in downtown Fayetteville. So we're right on the square in Fayetteville in the Pryor Center. So come see us or reach out to us 479-575-5148 or on our website, sbtdc.uark.edu. Anything else from you guys?